Schools focus heavily on core academic subjects like math, science, history, and literature. There's one critical topic often missing from the standard curriculum: personal finance. Without proper money management skills, it's easy to struggle financially after graduation. To help fill in the gaps, here are 10 essential personal finance rules you likely won't learn in school but need to know. Number 10. Devise a budget. Living within your means and saving enough to fulfill your long-term goals require a budget. The 50/30/20 budgeting strategy is a fantastic starting point. This is how it's broken down. Rent, utilities, groceries, and transportation use 50% of your take-home pay or net income after taxes. Discretionary expenses such as eating out and shopping for clothes receive 30% of the budget. Donations to charity can also be made here. 20% is set aside for the future, such as debt repayment and emergency savings. Thanks to a growing range of personal budgeting apps for smartphones that put day-to-day finances in the palm of your hand, managing money has never been easier. Number 9. Create an emergency fund. It's critical to pay yourself first to guarantee that money is set aside for unforeseen expenses like medical bills, a major auto repair, day-to-day expenses if you lose your job, and so on. The optimal safety net is 3 to 6 months' worth of living expenditures. Most financial experts advocate putting aside 20% of each paycheck each month. Don't stop saving once you've built up your emergency money. Continue allocating 20% of your monthly income to other financial goals, such as a retirement fund or a down payment on a home. Number 8. Limit debt. It seems simple enough. Don't spend more than you make to avoid getting into debt. Of all, most people must borrow from time to time, and going into debt can be beneficial in some cases. For example, if it leads to the acquisition of an asset. Taking out a mortgage to purchase a home is one example. Regardless matter whether you're renting a property, leasing a car, or acquiring a computer software subscription, leasing can often be more cost-effective than buying altogether. Number 7. Use credit cards wisely. Credit cards can be significant debt traps, yet in today's environment, it's impossible not to have one. They can also be used for purposes other than purchasing goods. They're not only important for building your credit score, but they're also a wonderful method to keep track of your spending, which can help you stick to a budget. Credit simply needs to be managed properly, which means paying off your entire bill each month, or at the very least keeping your credit utilization ratio low. That is, keep your account balances below 30% of your total available credit. Given the incredible rewards incentives available these days, such as cash back, charging as many products as possible makes sense provided you can pay your bills in full. The most essential thing to remember is to avoid maxing out your credit cards at all times and to always pay your payments on time. Paying bills late, or even worse, missing payments, is one of the quickest ways to destroy your credit score. Using a debit card, which withdraws funds directly from your bank account, is another option to avoid paying interest on little transactions that have accumulated over time. Number 6. Monitor your credit score. Credit cards are the primary means by which your credit score is established and maintained, thus keeping track of your credit spending goes hand in hand with keeping track of your credit score. You'll need a good credit report if you ever want to get a lease, a mortgage, or any other sort of financing. There are several credit ratings available, but the FICO score is the most popular. Set up direct debiting so you never miss a payment, and subscribe to credit reporting services that provide frequent credit score updates to pay your debts. You'll be able to spot and remedy errors or fraudulent behavior if you keep an eye on your credit report. The 3 major credit bureaus, Equifax, Experian, and TransUnion, are required by federal law to provide you with free credit reports once a year. AnnualCreditReport.com, a federally recognized site operated by the Big 3, allows you to sign up for reports directly from each agency. Sites like Credit Karma, Credit Sesame, and Wallethub all offer free credit scores. Some credit card companies, such as Capital One, offer free credit score updates on a regular basis, although it may not be your FICO score. Number 5. Consider your family. Make a will, and depending on your needs, set up 1 or more trusts to secure your assets and ensure that your desires are carried out when you pass away. You should also consider auto, house, life, disability, and long-term care insurance, LTC. Also, evaluate your policy on a regular basis to ensure that it continues to fit your family's needs as life's significant milestones pass. The living will and healthcare power of attorney are 2 more important documents. While not all of these documents are directly related to you, they can all save your family time and money if you become ill or otherwise incapacitated. Take the time to teach your children about the value of money and how to save, invest, and spend responsibly while they are young. Number 4. Pay off student loans. Graduates can choose from a variety of loan repayment options and payment reduction strategies. If you have a high interest rate, paying off the debt sooner is a good idea. Minimizing repayments to interest alone, for example, can free up cash to invest elsewhere or put into retirement savings while you're still young, when compound interest will benefit your nest egg the most. If a borrower enrolls in auto-pay, several private and government loans may be eligible for a rate decrease. The following federal repayment programs are worth looking into. Gradually increasing the monthly payment over a 10-year period is known as graduated repayment. Extended repayment, this option spreads out the loan over a period of up to 25 years. Income-driven repayment payments are limited to 10% to 20% of your income, depending on your income and family size. Number 3, plan and save for retirement. Retirement may appear to be a long way off, yet it comes far sooner than you think. According to experts, most people will require roughly 80% of their present wage in retirement. The earlier you begin, the more you profit from what financial experts refer to as the magic of compounding interest, which describes how tiny amounts compound over time. If monies are placed in a tax-advantaged plan, such as an individual retirement account IRA, a 401k, or a 403, they can not only grow over time, but they can also lower your current income taxes. B. Start contributing to a 401k or 403 plan as soon as possible if your work offers one, especially if your contribution is matched. You're squandering free money if you don't do so. If your workplace offers both, take the time to grasp the differences between a Roth 401k and a standard 401k. Investing is only one aspect of retirement preparation. Other options include deferring Social Security benefits as long as possible, which is a good idea for most people, and converting a term life insurance policy to a permanent life insurance policy. Number 2. Maximize tax breaks. Many people lose hundreds or even thousands of dollars each year as a result of an unnecessarily complicated tax law. By maximizing your tax savings, you'll have more money to go toward paying off debts from the past, enjoying the present, and making plans for the future. Each year, you should begin preserving receipts and keeping track of your expenses in order to take advantage of all possible tax deductions and credits. Many office supply retailers sell handy tax organizers with pre-labeled key sections. After you've gotten your finances in order, you'll want to concentrate on maximizing every tax deduction and credit available to you, as well as choosing between the two when appropriate. In other words, a tax deduction lowers the amount of income that is taxed, but a tax credit lowers the amount of tax owed. As a result, a $1,000 tax credit will save you far more than a $1,000 deductible. Number 1. Give yourself a break. Budgeting and planning can appear to be full of sacrifices. Make sure you treat yourself once in a while. You need to appreciate the results of your labor, whether it's a vacation, a purchase, or a once-in-a-while night out on the town. This provides you a taste of the financial independence for which you've been striving. Last but not least, remember to delegate when appropriate. Even if you think you're capable of doing your own taxes or managing a stock portfolio, that doesn't mean you should. Setting up a brokerage account and spending a few $100s on a certified public accountant, CPA, or a financial planner at least once might be a good approach to get your planning off to a good start. Share any other tips that you think we missed in the comments section below. Also, subscribe to our channel for more amazing videos like this. Thanks for watching.